This is Hubwonk. I'm Joe Selvaggi. Welcome to Hubwonk, a podcast of Pioneer Institute, a think tank in Boston. Inflation has eclipsed the COVID epidemic as Americans' greatest concern. Having not seen an inflationary spike for nearly 4 decades, many current consumers and market actors are unfamiliar with its causes, its effects, and the potential remedies available to policymakers to bring it back under control. Indeed, what had been thought to be a temporary phenomena attending the aftermath of a pandemic now vexes us daily as we shop for eggs, gas, or a potential new home. Will this ubiquitous rise in the price of everything continue and perhaps accelerate? Or can policymakers in our US legislature and Federal Reserve Bank slow and reverse this trend with interventions that voters will accept? My guest today is Ramesh Ponnuru, columnist for Bloomberg and editor of National Review. Mr. Ponnuru has written extensively on the causes and risks of inflation and on which politically viable actions policymakers can take to contain the current trend. Mr. Ponnuru will share with us his views on the origins and contributors to our current inflation, who is most likely to suffer from its effects, and which potentially painful policy choices are available to cool this overheated economy. When I return, I'll be joined by columnist and editor Ramesh Ponnuru. Okay, we're back. This is Hubwonk. I'm Joe Selvaggi, and I'm now pleased to be joined by Bloomberg columnist and editor of National Review, Ramesh Ponnuru. Welcome back to Hubwonk, Ramesh.
Thanks for having me.
Okay, now our topic is one that's at the top of mind for nearly all Americans. We're going to be discussing inflation, its causes, its effects, and perhaps give our listeners a sense of how we might plan to address it. So let's start at the beginning. First, for the benefit of our listeners, what is inflation?
So different people have defined inflation in different ways and sometimes get quite upset with you if you don't use the term the way they want to. I think the most intuitive and common way is also the most useful, and that is to describe inflation as a general rise in the price level. So if on average prices were at 100 in 2020, and then they get up to 102 in 2021, then you've got 2% inflation year over year.
Okay, is there a general sense of what it should be? Is there a sort of a background of, we should always have it, but it should be at this level?
So this too is a source of contention. Central banks around the world, starting in the late 80s, have largely converged on the idea of 2% inflation each year being the ideal or the target that they ought to be striving for. It's a little bit arbitrary, but the idea is that that creates a reasonable amount of price stability while also allowing for different kinds of adjustment to take place.
So in your first answer, you talked about the average price of everything being 100 is sort of an imaginary conceptual concept, and now it's 102. That means it's essentially a higher price for the same exact basket of goods and no change, such as a commodity like a gallon of gasoline is a gallon of gasoline from one year to the next. If it costs more, that's inflation if it's across the board. Now, if all boats are rising and inflation is increasing the price of everything, wouldn't it also affect the cost of labor, which is the flip side of inflation, which would effectively mean my paycheck, your paycheck would go up by the same amount? Does the rise in the income negate the effect of inflation?
Yeah, well, first of all, just to talk about one of the things you said, how changes in quality, so the idea that it's 2% inflation costing 100 and then costing 102 assumes you've got the same basket of goods. But of course, there can be all kinds of things that change. So if, the size of the candy bar you're buying shrinks, basically that's a kind of hidden kind of inflation, right? If the price is still the same. People call it shrinkflation sometimes. They do try in these statistics to capture that kind of change. Also, if the price of apples goes up, maybe people switch over to oranges, and there are technical disputes about how you correct for that kind of substitution effect. if people can avoid some of these price increases. Now, you're absolutely right that wages are another price, the price of labor, that is affected by inflation. And if you've got a steady and predictable 2% inflation year after year after year, the idea is that wage rates will adjust, that people who wouldn't have gotten raises will get a 2% raise. People who would have gotten a 2% raise will get a 4% raise. As sort of it's everybody in the economy just expects the price level to be a little bit higher next year than it was this year. But of course, that's sort of a textbook model of the way inflation works. And in actuality, inflation doesn't work that way, particularly when you've got unanticipated inflation, where maybe it takes some time for this inflation to permeate every market, including the labor market. And during that period in between, if you're a wage earner, you're finding the purchasing power of your paycheck going down. And of course, there are other kinds of there are other things that can happen with inflation that cause the price of the products you buy to rise, but don't help your wages. And that's the case with a supply-led inflation, an inflation that is caused by a blow to your productivity.
I see. So inflation doesn't rise all boats. Sometimes it's an uneven rising. If you're either, let's say, not an income earner, or you're maybe fixed income retiree, you're a saver, your savings don't grow with inflation. So you may be left behind. So let's talk about that. What are some of the primary negative effects of inflation in conceptually?
So the loss of purchasing power, of course, is the one that is closest to everybody's mind, but it also makes the economy less predictable if you've got an unsteady inflation. And so that makes it harder for businesses to make investment plans, for example, or for households to make long-term plans. They don't have that steady backdrop against which they can make the plans. There's also what's called menu costs. And just think about it very literally, like the restaurant has to keep changing the menu because prices keep changing. There's the way that inflation is baked into some taxes. Now that's better than it used to be. In the 70s, when we had our last big bout of inflation, the income tax brackets weren't indexed for inflation. So people would find themselves paying higher taxes even when they weren't getting ahead in real purchasing power of their income. But it's still part of our tax code and things like capital gains. So you can end up paying a capital gains tax when you haven't in real terms made any capital gain. And the effective tax rate therefore keeps going up. So there are all kinds of costs that ripple out through the economy.
Okay, so let's ask let's get into the meat of this. We know what inflation is. This is a harder question. What is it that causes inflation? You've already mentioned a supply shock, but let's go deeper into that. I'm sure it depends on who you ask, but what causes inflation?
Well, the typical cause of inflation is an excessive growth in the money supply. But really anything that increases the total level of spending is going to cause a demand side inflation. That's most of what we saw in the 1970s. It's part of what we're seeing now. If there's, the famous definition of inflation or explanation for inflation is too much money chasing too few goods. Now, the too few goods, that's the supply side of the problem. Too much money, that's the demand side. That is the central bank running a monetary policy that is too loose, that is leading, to too much currency in circulation. For example, would be the very classic case of how a central bank can go wrong with inflation. And another metaphor people often use for this kind of inflation is overheating the economy.
I see. So you've mentioned a couple of things. I think that you were both channeling Milton Friedman there with the too many dollars chasing too few goods. So let's analyze that equation. We've got too many dollars and too few goods. Let's start with the too few goods. We all know that we have supply chain issues. We've covered that on this podcast in earlier episodes, but let's analyze that. Are we still blaming too few goods on supply chain shocks that were a result of our recent pandemic?
I think that was a bigger cause of the inflation in the first half of 2021. And it is a pretty big cause of the inflation that we're seeing in Europe. But it's been less of what has been afflicting us for most of the last year. So still a factor, but since mid 2021, I would say too much spending has been a bigger part of it. And by too much spending, I mean really the total level of spending throughout the economy, all spending on consumption and investments, public and private and business. It's you want that growing at a steady rate, and it hasn't been. It dropped substantially at the beginning of the pandemic. Then it rose sharply, and I think some of that sharp rise is justified as a way of catching up after you had that big drop. But it's been excessive, and it's been, I think, clearly excessive since late 2021. And the central bank has been too slow to arrest that.
I see. So we're talking about a constraint in supply and then an attending inflow of spending. So again, we hear a lot about energy constraints. Price of gas is top of mind for everyone. I think it's gone up 50% in the last 18 months. The administration is calling that the Putin price hike. And of course, gas is an input for all other goods. Can we attribute some of this inflation to spike in energy price?
Yeah, absolutely we can. That's typically the case. But of course, gas prices were rising before Putin's invasion of Ukraine. I think there's no question that that invasion has made things worse, but we had an inflation problem before it. And the excess spending problem is not a Putin-caused problem. It's that is a domestic policy problem. That's a central bank problem. The point you made about gas prices being energy being an input into almost everything else. That's a very important point because sometimes people will say, well, if one price goes up, people can just spend more on that and spend less on other things and shouldn't change the overall inflation rate. And that's really not true when it comes to an input price that has a negative effect on productivity, like an increase in energy. It's like making everything, if you make everything twice as hard to make, like take twice as much labor to produce the same amount of products, you're going to have less output and or higher prices. And there's not a whole lot that a central bank can do about that. So all just a way of saying that the input price issue is absolutely part of this problem. And we just have to be able to hold in our minds that we've got both a supply and a demand problem. And too often people want to make it one or the other. Democrats typically want to make it an entirely supply issue, as though that absolves them of any responsibility, which it actually doesn't. But it's also not true. It's both.
So okay, let's move off of the supply side and towards the demand side. You've already cited the fact that a lot of people through the pandemic were sitting home, not spending money. They couldn't spend money. They're stuck at home, perhaps saving, and they would naturally want to make up for lost time when restrictions are lifted and we can all get back out there. So we've got that spike in demand as you described. But there was also, of course, a stimulation of that spike in demand by the federal government. In many ways, it influenced our ability to spend. There were direct outlays, there's debt forbearance, unemployment supplements, payment protection programs, all kinds of alphabet soup of stimulus. Of course, that's introducing the idea of far more dollars chasing the same number of goods. Is that, to what degree is the federal government's fiscal policy to blame for the stimulation in demand?
Well, here I think it's a complicated story. And I thought that a lot of the spending that the federal government engaged in 2020, and particularly in early 2021 with President Biden's so-called American Rescue Plan, was excessive. And I thought it was excessive for a variety of reasons, mostly having to do with wasting money that could have been more productively spent elsewhere in the economy, and creating bad incentives. But at the time, even though I was opposed to Biden's spending plan, I thought it wouldn't have a big effect on inflation, partly because changes in spending over the previous decade hadn't had a big effect on total spending levels or on inflation because it had been offset. For example, in early 2013, you'd had some spending cuts from the federal government and some tax increases, and the central bank offset that, so that the overall effect on the economy wasn't very big. This time that didn't happen, because the central bank was simultaneously engaged in a kind of loosening of policy under Jay Powell. Partly loosening, as a response to the pandemic and the effect on the economy. They thought it was the right thing to do, but the combined effect of this fiscal and then monetary loosening was excessive, and that's how we got here. And I also think, if you'll permit me a little political digression, one of the reasons that the Federal Reserve let things get out of control in the second half of 2021 was there was uncertainty about the leadership of the Federal Reserve itself, because Biden had not committed to renominating Powell, and there was a great deal of pressure from the left, and the left typically doesn't like monetary tightening, likes monetary loosening. And the Democratic incumbent is definitely going to not want interest rate hikes. And I think that can help explain some of the delay in responding to the clear signs that not only did you have an inflation, but this inflation was not transitory. And this inflation was, in fact, fed by excessive demand, excessive spending.
So, I mean, you say that rates or have a political valence, but I think what you're really trying to say is for incumbents, not for left or right or Republicans or Democrats, right? And all incumbents want low interest rates and let's say a heated, perhaps not overheated, but a heated economy. Nobody wants.
Well, I think it's both.
Afraid, right?
Yeah, I think it's both in this case. I do think presidents just typically, they want low interest rates. They don't want to have the risk of a recession from an increase in interest rates. President Trump was certainly a low interest rate person, which also I think has to do with his background as a real estate developer. But I think that there's also this additional ideological overlay, which is that the left tends to favor looser policy than the right, and tends to think a little more inflation is more tolerable than the right does. Now, I think that this is actually, particularly in this case, a mistake, that Biden and the Democrats would actually be better off if we'd started this tightening cycle in late 2021 and gone a little further in that. I think we've actually got a pretty strong labor market. If you look at vacancies and employment growth, and the economy could have withstood that, and you'd be better off as the party in power with inflation under greater control. I mean, you might be facing some losses anyway because you're coming into a midterm. Midterms typically don't go well for the party in power, but I don't think you'd be seeing the potential catastrophe that Democrats are now seeing, where I think, in a very real sense, inflation is just devouring this presidency.
So let's again. The party in power is uncomfortable with the levels of inflation we're all seeing right now. It's not good for their prospects in November. But let's dispense with some of the, or not dispense with some of the narratives that are coming from the Democratic Party. A lot of people blame inflation on the exploitation of sellers, or
Oh, right.
so-called
Yes.
greed of corporate. We have our own Elizabeth Warren. She's our senator, or one of our senators, who has a wonderful creative portmanteau called greedflation. That essentially this is suddenly corporations have become greedy just recently. So, is there any merit to greedflation?
Well, I mean, I think you've hit on the major problem with it, which is that it attempts to explain a variable by reference to a constant. Companies are always trying to maximize their profits. It's not like we had low inflation for most of the last decade because companies decided, we don't actually care about making profits anymore. So something has to have changed where a bunch of companies, all through the economy, all at once decided that the way to do that was to raise prices. And I think that once you start thinking in those terms, you just see how pitifully inadequate Senator Warren's explanation is. She has responded to this inflation by introducing legislation that would prohibit large companies from, I think the phrase is unconscionably excessive price increases. Well, what does that mean? Who would define it? How much litigation would be involved in that? But also, if you look into that legislation, she says, you're allowed, if the bureaucrats decide essentially that you've got a supply chain problem, then okay, you can raise your prices enough for that. But implicitly, what they're saying is you can't raise your prices in response to changes in demand, which is nuts. And like a market economy just can't function if companies aren't allowed to set prices in response to changes in both supply and demand in their markets.
Indeed, we probably could do a whole podcast on the downside of price controls and why they lead to breadlines. But let's move away from that and talk about the other way the Democratic Party right now is deflecting from this concern about inflation, saying, look, we've got inflation, but so does the rest of the world. We're looking at Europe. They've got inflation. Biden certainly hasn't affected their policies. How is it that we would be blamed for something that is a universal phenomenon?
So there are two things that bear watching. One is there is, I think, just a kind of, you've got some of the same policies being pursued everywhere. So I think European Central Bank policy was also too expansionary. And I think, though, we've also got a little bit of a coincidence because you've got a bigger supply problem in Europe right now, and you've got a bigger demand problem here in the United States. So you've got the same sort of a very similar kind of headline inflation number, but very different causation in both cases, and different policy responses are called for in different degrees in each of the cases. That was, you may not have said it, but that was all explanation one. Explanation two, I do think there is something to the idea that the United States is the world's monetary superpower, and that if it's deflationary or inflationary, that tends to get exported to other parts of the world for reasons having to do with, for example, other currencies being pegged to the dollar. But I think that there's something a little screwy about the leadership of the United States saying, well, this is a global economic problem. It's not our responsibility. I mean, we're the United States.
Right. Indeed. So let's move away from. We'll accept and stipulate that we do have it. It is here. We do think we can have policy choices that will make differences. But let's start with we're coming out of the COVID-19 pandemic. Thank God. And theoretically, supply chains will go back to normal. Will that likely happen and be, let's say, salutary to those hoping to reduce inflation? In other words, if we resume our supply, will the demand for that short supply normalize, and that will battle inflation?
Yeah, I think that that as supply chains get unsnarled, I mean, unless there are more um, shocks, right? Because we had the pandemic shock, and we had the Russian invasion shock, and the world might not be through with shocks. There was concern. I think it basically hasn't panned out, but there were concerns that the resurgence of the pandemic in China would cause big supply problems. So you can't rule that sort of thing out. But one of the things about supply shortages is that there are powerful market forces that act to fix those. And that should happen over time, and that should reduce that level of, or that kind of inflation. But you've still got the demand problem. And the excessive spending is not something that gets fixed just because supply chains get fixed.
So, okay, then let's shift it. Even if we do have plenty of supply, we've got too much money still.
Right.
I think we have Senators Manchin and Sinema to thank for the fact that we don't have an additional $3 or $5 trillion in a Build Back Better that was not passed, but quite a bit of stimulus was in the trillions. I believe another $5 trillion in sort of pandemic stimulus. That's still filtering down. Is that stimulating helicopter money going to continue to overstimulate us well into the future? Is it, if we turn off the spigot, how long will it take to again normalize?
Well, I think that obviously it takes time for some of these changes, both positive and negative, to work their way through the economy. And so people say that monetary policy has the phrase everybody uses who studies this is something like long and lagging effects. However, I think some of the effects would be a little faster than that. The signals to financial markets that the Fed is serious if it raises rates enough to give the markets a jolt. That shows up in, as we've seen, some of that shows up in asset prices. Some of that shows up in just market expectations of future inflation. And when markets don't expect future inflation to be so elevated, that in itself has a salutary effect, because people aren't trying to raise their prices to keep up with what they see coming for them. So I think that a good policy change could have quicker effects than people sometimes think.
So we're talking specifically about monetary policy. We're talking about the Fed, Jerome Powell. We're actually recording on June 15th before the 2 o'clock announcement of rate increases. So we can speculate here, but our listeners will know what the outcome was. Well, I think odds on favorite are for a 75 basis point increase. For the benefit of our listeners, how is it that this change in rates could have an effect, hopefully have an effect on dampening inflation? How is it effectively we're making money more expensive? How does that filter through the economy and then ultimately tame inflation?
Well, there's a mechanical effect for example, it cools the housing market. If interest rates are higher, people are not as quick to purchase homes and to bid the prices of homes higher. So there's that effect on inflation, and then that also affects rents. But I actually think that the biggest effect is simply the expectations, that when people have confidence that the Federal Reserve is going to do whatever it takes to get inflation back under control, that's the most powerful effect that the Fed has. And in fact, the more confidence there is, the less actual interest rate increases the Fed has to engage in. a lot of what the Fed has to do is changing market expectations. It's just like sort of, the primary way that traffic signals, green and red lights, work is not through police tickets, right? It's just changing the way drivers act, and it's not self-regulating, right? It's the government setting up those traffic signals, but it's a kind of nudge to market participants to act in a particular way and to have certain expectations and expectations of what other people are doing on the road. So too here. And a lot of what I think went wrong for the Fed last year was that it was sending the wrong signals about its intentions and how committed it was to keeping inflation from getting out of control in the first place.
So I think you've anticipated. I was going to ask, how high does the Fed have to raise interest rates to essentially tame it? But your answer, I think, I'm going to guess, is it has to raise it a lot less if everybody accepts the fact that it will do anything it takes to raise interest rates. So if you don't believe, if you believe that the Fed is on it and they're doing their job and they plan to do their job, expectations for inflation go down, ergo rates don't have to go up quite as high as they would otherwise. Is that right?
Yeah, that's right. And one of the reasons I think that the Fed ought to surprise the markets on the upside by having a little bit higher of a rate increase than people expect right now is so that they don't have to keep doing it. So that maybe that ends up being enough to convince people that this is the end or the beginning of the end of this burst of inflation.
So we're running out of time, but I do want to get to the sort of historical. You're trained as a historian, so I thought I'd ask a historical question. We did reference the 70s and what happened then. I'm old enough to remember, but I wasn't buying houses at that time. I was playing on the schoolyard. But back in the late 70s, early 80s, we had rampant inflation, and then Chairman Volcker came out and essentially tackled an extreme bout of inflation with interest rates, in the double digits. Are you concerned, looking back as a historian at that bout of inflation, really the last time we were here, that we will see that kind of pain? Because of course, those kinds of interest rates cause enormous amounts of unemployment and recession. Are we inclined to have to go that far and be, will it be that painful going forward, in your view?
I think we ought to be able to avoid that degree of pain, because we got to remember that the inflation of that period took quite a while to develop. And it took a while for people's expectations, excuse me, of inflation to shift upward on a sustained basis. So you started seeing that increased inflation in the late 60s. And then policymakers sort of flailed around in response for more than a decade. Right now, if you look at long-term inflation expectations, if you look at measures of what the market is expecting inflation to be 6 to 10 years from now, they're a little high. I think the Fed needs to bring them down, but they're not wildly high. And if you look at that, which means that the Fed doesn't have to really upend people's expectations, it just needs to moderate them, bring them down a little bit. And you combine it with the fact that the labor market's in pretty good shape to start with. Those things suggest to me that if the Fed does the right thing now, we can have, if not the sort of soft landing, we have a tightening cycle that doesn't result in a recession. But if you do have a recession, maybe it can be mild and short.
All right, so we've talked about many of the levers that government has to combat inflation. We've talked about how it exacerbated inflation, but we're now trying to turn the ship around. In your view, given the government we have, the upcoming midterm elections, and the policy choices that are on the table for those politicians who want to remain in office, what other levers do you see that we could be pulling to mitigate the effects of inflation and inflation expectations?
Well, I think there are an enormous number of government policies that have an effect on productivity. And it's typically a negative effect on productivity. And if you simply lifted some of those burdens, you would contribute to the long-term productivity of the economy, which is just a good thing to do in general. And that would also put some downward pressure on prices. Not all of it would be quick and immediate, but some of it would. So, for example, reducing tariffs would, particularly if you reduce tariffs on critical inputs, like the things you use to make semiconductors, that would, I think, have a pretty quick effect and put some downward pressure on prices. If you increase domestic energy production, got rid of some of the restrictions on that, that would also have an effect. And maybe some of that would even feed into today's prices, because it would affect people's expectations of future prices and future supply levels. We had this huge infrastructure bill that was supposed to make our economy more productive, but there's language in that bill at the behest of Democrats that prevents you from using any of it to automate the ports, which is something that we ought to be doing to make supply chains more efficient, but that unions naturally dislike. And so the Democrats won't go for. The problem that you come up against again and again is there's either an ideological objection or some kind of political interest group objection. And the natural instinct of the Democratic Party is always restrict supply through regulation, subsidize demand through spending. That's a recipe for more inflation. And it makes it very, very hard for them to respond to inflation in a way that actually helps solve the problem.
So we can't blame it all on Democrats. I suppose also Republicans resist. Donald Trump, in particular, was a fan of tariffs, and protecting American jobs. What you're saying is free trade is one of the main remedies for fighting inflation, including facilitating that free trade through ports and such. Is that what you're saying?
Well, I wouldn't necessarily say it's one of the main remedies, but it is a remedy, and it is something that could be done. I mean, the president could do a lot of this with a stroke of a pen, because a lot of the tariffs were imposed by the stroke of a pen. And so if you really think that inflation is a huge threat, I think you try to attack it on all fronts, and you do the things that you can do.
Indeed. All right, so we're getting close to the end of the time together. I don't know if you want to dust off your crystal ball right here. I'll ask you the $64,000 question. How high do you think inflation will go? I think we're looking at headline inflation of 8.6%. That was Friday last week was what the annualized inflation rate. How high can it go, and how long do you think it'll last?
Well, I don't try to make predictions, especially about the future, as I think Yogi Berra said. But my sense has been that policy has consistently been a little bit too little, too late. I would like to be pleasantly surprised, but I think that we are going to have this elevated inflation level for some time. So I think we're going to have it into 2023.
Indeed. Okay, so sort of a grim outlook, but at least it is temporary. Depends on your timeline. It will end. And so you've called it 2023 is when we start to see the light at the end of the tunnel. I'll take that to the bank. Thank you very much for joining us today on Hubwonk. Ramesh, you're always a welcome guest and a fund of information. Thank you for joining us.
You're most welcome.
This has been another episode of Hubwonk, a podcast of Pioneer Institute. If you enjoyed today's episode, there are several ways to support the show. It would be easier for you and better for us if you subscribe to Hubwonk on your iTunes podcatcher. It would be easier for others to find Hubwonk if you offer a 5-star rating or a favorable review. We're always grateful if you want to share Hubwonk with friends. If you have ideas for me or suggestions or comments about future episode topics, you're welcome to email me at hubwonk@pioneerinstitute.org. Please join me next week for a new episode of Hubwonk.